All right. Well, to get started off, Chuck chimes in. It's been a little bit of a rough week, right? We saw some movement down. The SPX did come back up after the drop this morning after the stronger than usual jobs report. We saw another dip Wednesday and Thursday. But Chuck says, "Good day, Michael. I hope you had a prosperous week." Well, it was interesting that some of my married puts, this is AMD, actually dropped below $100 recently, but then came back. Fortinet was down, I think, as low as $56, but came back nicely. It's about time to do an income method and adjustment there. NEM's wavering on me, but that's just, about 40 to 50% of my account. ASL, not happy with it all. My expectations with this would hold around the $48 or $51 level, and it clearly did not. So I want to consider what to do with that as well. But I did have some fun, of course. It took a turn today, but I actually got out of it yesterday. A couple of weeks ago, we were talking about the performance of the VIX and the volatility indexes and ETFs. That came about with a discussion, I believe, Chuck, from you, I believe, when you had asked about doing a married put on the inverse volatility ETF, if I'm not mistaken. And when we looked at the view at that time, let me see here. Let me just go to the charts for the VIX. So we're looking at the SVIX as it was. And the idea was, hey, if the VIX is dropping, a married put position, buying shares of that negative VIX ETF and buying a protective put option as discussed in the blueprint, when the VIX started to pull down, this would be a bullish position because SVIX would start moving back up. But when we started to get into these levels during that conversation, we were in the 14 and a half range. Actually, I believe for me, I looked at it back here, but then the VIX did this. But right when it was around here, I think, it was in this section here around the 1450 range, I bought 75, 65 day out calls on the VIX. So this week was actually pretty profitable for me. I think I exited half of them here and just closed all of them here after it pulled back the other day. So it wasn't a great return. Oh, different Chuck. Yeah, that's right. I'm sorry. It was a different Chuck. My apologies. So Chuck R. Was the one that commented first, and Chuck S is the one that we discussed that SVIX with. But yeah, so the calls on the VIX there did really well, although, as I mentioned, the married puts are still limited risk. One of them is bulletproof. One of them has less than 1% risk. One of them is only 2% risk, and most of them have protection out beyond January. Though we'll have to manage one of the positions. I think it's that ASO one I'm really disappointed in coming up to expiration, I believe, in October, if I'm not mistaken. So I got to do something with that one. I don't know if I want to extend it. I think I do because I think I could get a much lower loss out of it. Right now, it's about a 6% loss, 5.5% loss. I think I could drastically change that to under 2%, and we're going to take a look there. I didn't pull the trigger, honestly, on any bearish positions because I didn't have the full confidence that what we were seeing was going to last. It did. I mean, here was the naturally, this time here when the VIX is increasing, it's on rumors, but this was all bearish, and then we had a little flop, and this was the bearish moves. But I didn't do any strong bearish positions. I was thinking about, again, sort of at-the-money Bear Put Debit Spreads that were 50 to 60 days out in time. Low probability of getting the max return, but having a closer to 1-to-1 risk-reward ratio. And in those situations, what you do is typically look to close them. Let's go ahead and take a look here at some of the things I might have considered. Well, I have the bear call credits up here, but not the bear put debit spreads. I wouldn't do this at the money topic I'm talking about with a credit spread. You only want to do it with a debit spread, a bull call debit or a bear put debit, even though they're parity trades of the bull put credit and the bear call credit, respectively. The debit spreads, you don't have to worry about early assignment if the position goes in the money or if it goes between the strike prices, because you're covered. If it's above the short option in a debit spread and you get assigned early, your broker's just going to exercise the long. The stocks between the two strike prices in a credit spread, it went against you. Well, you might get assigned early on that position. Sure, you have the extra option at the lower strike price, but I might end up having to buy shares of stock or being short shares of stock because the other option I had in the credit spread isn't in the money. But in any case, the at-the-money debit spreads is something that's an alternative that's used. And if I'm not mistaken, under the sample searches is typically one that I use for these types of market out of the money, out in time, bear put debit spreads. Okay? 60 days or more out in time. This is the basic search that I would use. And I just want to take a look at some of these, not the ones that came up today, because again, I'm not sure if we're still in a bearish mood. We saw the market sort of settle, take off down this morning on the jobs report, then it settled back up. But about that time I mentioned a couple weeks ago or so, I was considering some of these. So let's just go ahead and do this. What I'm going to do is, I'm not going to change anything. I'm just going to go ahead and submit this. So it'll put it in the search tool for us. And then I'm going to save this as the ATM out in time debits. All right, let's just go ahead and click Save this search. Remember, started in the sample searches where there's that theme search for the at the money, sort of out of the money debit spreads. Right now, for example, one that's available on Upstart with the stock at $27.55. Going out to December, 70 days away, we might sell the at the money $27.50 put and buy a 30 strike put for a net debit of $1.55. What does this do to the position? Well, instead of going in the money on the debit spread for the higher probability, or going deep out of the money on a credit spread for that higher probability, the 85, 80% or more, that the position would stay above or below your short option strike price, the credit spread would expire worthless. Here we're shooting for more, closer to a 1-to-1 risk-reward ratio. Instead of that 80% probability credit spread, which I might be getting 30 cents against a 2 or 2.5 point spread to make a good leveraged return of 11, 12, 15, or 17%. But in reality, I'm risking 7-to-1 or 8-to-1. If I get 30 cents on a 250 spread, I'm still risking 220 to make 30. I've got an 85% probability that that trade might work out, barring any black swan events. That's what I look for in the credit spreads. But in the debit spread approach here, going farther term instead of weekly or 2 weeks out in time with the income strategy, the credit spread, we're looking for a position that has that lower probability of staying below the short option strike price. We're right at the money, but I'm only paying $1.55 on that 2.5 point spread for the potential to make 95. We're getting closer to a 1-to-1 risk reward ratio. Again, I only do this with the debit spreads, not the credit spreads, because if the stock falls down here, or if it moves up here, remember, this is a bear put debit. We're selling that $27.50 and we bought the 30. If it falls here and I get assigned early on the $27.50 put that I sold, no problem. My broker would likely exercise the 30 to deliver that. I'm out with the max profit early on the position. If this was a bear call credit spread, where this is now a call, relative parity structure, but if this is a 27.5 call and the stock moves up to 28 or 29, my insurance policy doesn't kick in until 30. So if I get assigned early here on the short call that's now in the money in the credit spread, I'd end up being short shares of stock. Yes, I still have this protection in place on the position. When I entered the credit spread, I didn't want to mess around with being short the stock, borrowing it from my broker, or being long the stock if I was assigned early in a bull put credit spread because the stock was between the strike prices. Debit spread, I don't have to worry about that. I'd pray for early assignment because then I could get my max return faster. But let's take a look here what would have happened about 14, 15 days ago. Let's go 14 days back in time. Let's go into the backtest tool. And of course, let's just go back to September. Of course, let's go back to about the 22nd, I believe it was. Yeah, it would have been the 22nd. That would have been the other Friday. And we're going to search for that ATM out in time debits. I think when we had this discussion on the VIX ETF, it was actually 3 or 4 weeks back. So what the, excuse me, folks, what the system is doing now is it's going across the universe of options to identify the positions that would have matched our default criteria. Now, there's some duplicates in here. I'm not using the one result per security checkbox that you can use in the various searches. So I've got a couple on DOCU, and I've got a couple on GME, and a couple on HRL, Hormel Foods. So now what I see is I see the positions that would have matched my criteria, percent returns around that 60, 70 level. We're 84 days out in time. Remember, our criteria was going at least 60 days out in time for this at the money debit spread, where I'd likely look to close the position once I reached 50% of the max expect profit. I'm not going to try to hold it all the way to the end. If I could close this out for a 25% return, sometime during the first couple weeks of that trade, I would take it off the table and move on. Let's see how they stand. Yes, they're 84 days out in time. We've seen some market fluctuation, of course. This takes a while right now. It's usually pretty quick. But what it's doing is it's calculating the total results from when we would have entered the position on September 22nd to see what the gain and loss on each one of these positions that matched our criteria are right now. We can actually do more in-depth research also to go back in time and see what the performance was on each day so far, where the max return is for the position or the max loss. Now, I apologize, it's taking a while. The reason why is because right now we are loading up all of today's end-of-day historical data on the position for every option and every stock, I should say. So the tables are getting filled with a lot of data. In the meantime, we're trying to interact, I should say, with those historical data tables that currently are going through a lot of interaction with today's closed values. So it's still loading there, and so we'll get to that in just a moment when it comes up. But the historical suite of tools are a way that you can test out a criteria set that you had in mind. And so you could say, hey, if I have this idea of doing this on a covered call position or dividend covered call, I want to see what this structure of a caller might have done. That's what our historical tools can do for you. During the trial, you have 3 months access to the historical tools. As you saw, when I clicked that drop down, it took us back into a little bit of August in those cases. But as a full subscriber to the historical level of services, you would have up to about 6.5, 7 years of historical data to go through with the different strategies, different criteria sets, and much more. So in addition to the backtesting search and search by symbol as the historical tools, you also have access to the historical chain. Now, I apologize, it's still taking a while to interact with those tables. We might move on briefly from that and then come back in just a few moments here when that goes through. So sorry about that. It's always kind of risky when we do the historical tools. The search came up really quick, fairly quick for what we're doing right now. But the results just aren't having a good time loading for us. So unfortunately, we're just going to have to wait to see that in just a few moments. But again, this is a sort of an idea of getting closer to that one-to-one risk-reward ratio. Now, the Bear Put Debit Spread, of course, is a parity trade to the Bear Call Credit Spread. You could see that in the structure here. Now, if I was creating a Bear Call for Upstart with a stock trading at $27.55, I'd more than likely look for that higher probability position. But I'd be shorter term too. If today I might go only 14 days out in time, but on the Bear Call, I'd likely be selling the out of the money 30 strike. Oh, there's other strikes available. Good. Yeah, but for that probability, I'd probably do the 30 and maybe the 32.5. Let's get rid of that. Let's try that again. See if I can get the calculate group results to come up without the timeout. Sorry about that. There we go. Now, so at a Bear Call credit spread, I want to be further out of the money to avoid that risk of early assignment. So I still have the potential to make a reasonably strong return on the position. Let's take these 50s out to make it a little bit more clean. There we go. See, I have a max profit of $47 with a true risk of only 203. So we're looking at a reasonable 25% return, but I want the stock to stay below 30. So both calls expire worthless, and I keep the premium on the trade. But you get closer, as you can see, to that 5-to-1, 6-to-1, 8-to-1 risk-reward ratio when you look for those better probabilities in the credit spreads themselves. Now, of those debit spreads, I don't think anything's... Oh, no, there are. There are some here that are probably near the 50% return on GME. When we open the Bear Put Debits for the stocks at 17.18, it's at 15.08 now. AP is at 35.3% profit. Now, it's 35.3% total. So if the total profit was only 70, we might be taking off the table now. That stock was at 57.60 2 weeks ago. It's at 51.99 right now. HRL is at 38.91. And the stock's at 36.87. So not as big as a move, but we could take profit on the positions right now from the debit for a 51.4% return, 62.5% return. The only two that are losing are docu positions, where we open the stock. Well, we would have looked at the Bear Put Debits when the stock is at 41.50 and it's currently at 42.13. So right now we're at an 82% success rate with an average return of 23%. I didn't do all of these positions. I don't think I did. No, para. I'm in para right now. It's not near that full profit range. It's down to 1182. But it was a different trade. It wasn't. No, it was. It was a 12.5, 15. It was for November. It wasn't for December, if I remember correctly. So with that, seeing sometimes the sell warnings on the market sentiment tool and power options. Now we start to see the light buys. I might consider one or two flyers looking at those at the money debit spreads that are likely going to be out, in this case, December, that 70 days away that we saw, for some smaller profit, probably not putting more than 2 to 3% of the portfolio and maybe 2 or 3 positions, so maybe 5 or 6% total. But of course, took the chance with the jobs report and took the chance with some other information we knew was coming out this week, and it worked in my favor. If the jobs report would have started off the other way and met the expectations, likely the market would have jumped up higher. If the bond yields could have fell down a little bit more, we might have seen a stronger market in these last 2 days than we've seen, and the Bear Put Debit Spreads probably would be doing as well. There's a little chance I took, but that's why it was only with 2 to 3% of my portfolio in each little position, only about 3 positions opened. And like I said, the para one's profitable. One of them is not profitable, but it's not at too big of a loss. The third one, I think I've already closed. Okay, so just wanted to point that out there with some of the ideas. The prosperous week, as Chuck mentioned, there's some ideas flowing around there. The VIX calls worked well. Those bear puts did okay, but not great yet. And if with the light buys showing up and the bullish buy the other day, actually, in the market sentiment, probably should have taken all of those off right now and start maybe looking. I might start looking beginning of next week for some bull call debit spreads, depending on the news that comes out over the weekend. But I just want to remind everyone that today's material are my thoughts on your questions, ideas, designed for educational purposes, increasing investing performance and options knowledge. Any stock or options discussed today should not be taken as direct recommendations or trading suggestions. Options involve risk, and they may not be suitable for all investors. But did you get a chance to look at some of the tools today? We looked briefly at the search tools and some of the default criteria. We spent some time with the historical tools for analyzing different trade structures or criteria that you want to see might have performed over the last 1, 2, or 3 months or so. We didn't look at the portfolio today, but we looked at some of the signature tools, the parity trade, the spread trade tool, and the option chain for evaluating parity trades in covered calls and cash secured naked puts. Well, you can test all of that for 14 days. Of course, just go to PowerOp.com, put in your name and email address, no credit card required. You'll have full use of the site for 14 days.